All right, good morning, everybody. The FedEx earnings didn't go that well. Now, to be fair, I haven't had a chance to listen to the conference call. I'll dig through that today, but make no mistake about it. As much as it doesn't seem like much of a company who cares. It's not tech, it's not software. FedEx matters. So, gonna really want to pay attention to what went wrong there, and you want to hear what they have to say. It's that forward outlook that is the most important piece of their earnings. And I don't have it yet. I need to dig into it. You do you. Next up is Micron MU. It already was the light in the dark. Everybody's been piling everything onto it as this symbol of the strength of the movement in AI and whether that trade is still alive. But it's more than that. And the amount of trading volume in that thing is greater than the S&P. It's greater than everything. The volumes in that are nuts, just completely nuts. So it's kind of a really big deal, and it has the power to break things, and it's right around the corner. And a lot of people have no idea. Good morning. Now, once we get past Micron's earnings, then we got PCE on the 25th. That's tomorrow. So once we're done with that, we should be good, right, for the rest of the week. Not much left of it, but that'd be kind of the end of things after that. So small caps close to flat. The Dow is flat. S&P up a quarter, and the Nasdaq more than a quarter, but less than a half. So I mean, they're green. They're just not screaming higher. And Japan kind of in the same boat. Starting to feel like a market that's waiting on something. Not really expecting much out of the bank stress test results. They interviewed Jamie Dimon a little while back on this. He didn't seem to present any red flags. But if you are trading tonight in the after hours, make sure you have already absorbed whatever the results were from the stress test. All right, it's Wednesday. We're going to get crude oil inventories. I know the Middle East headlines are revolving in a circle like yes, no, maybe things are fine, no they're not fine. We are getting closer and closer to a real crisis in crude. Now I hear they're starting a task force to try to understand why US gasoline prices aren't falling as quickly as the price per barrel, as if there's some nefarious shenanigans holding up the what a waste of time. It's just a symbolic gesture. It doesn't mean anything. But they get to spin their wheels and spend taxpayers' dollars. So we want to see the numbers we get at 10 a.m. or excuse me, at 10:30. The 1 p.m. auction is the 5-year note. Not really excited about that. I would be completely shocked if we get anything from that. Not really all that piled up, you know. It's kind of thin, all things considered. All right, we've been talking about this for a while. It still remains the one of the biggest things in focus is the potential for a rate hike and the fact that the market has priced one in starting in September. They managed to do this without dropping the market all that much. It was a really nice magic trick. And we want to watch in here to see if things get brought up into the July 29th meeting, which so far there's no reason to think they're going to do that. And or if they start pushing that rate hike out farther along the curve. That would be pouring gasoline on the fire and would give us the expectation of the S&P, the Nasdaq going higher. We did see the VIX get above 20 for a little bit. The real number is like 1920 or something like that. There's this historic mean that really matters. But, big round numbers tend to be easier to remember. So $20 on the upside, 15 on the downside. We are in this zone where we're right on the edge of what's considered a more dangerous level. The thing about the VIX by itself is it's not enough. There's times where the VIX really matters, and then there's times where the market just completely ignores it. So what we want to be mindful of here is a rate of change, a significant price differential from one day to the next, and any sort of behavior where we have like a spot up, vol up scenario, or that we start to see um, backwardation slip in along the curve. I know that might sound a bit complicated early in the morning. It's the idea that things farther out in time should be more expensive because there's so much more unknown that can happen the farther out you go. War, famine, hurricanes, drama. There's just so much in the future that we can't anticipate or predict. And that causes prices, generally speaking, to be more expensive the farther out in time you go. That logic or that idea is normalcy. It's contango. So when we're in contango, everything is fine. Big fancy language. The concern is backwardation, where the front end gets to be more expensive than the back end, and that's not normal. Signals that the money in the market is more worried about the next few days or the next few weeks and less concerned about what's farther out in time. Just like yesterday, we're hanging near the edges between a positive and negative GEX. The SPX flip point 74.25. I'll just add a point there. And for the futures, 74.47. To the downside, you can see we don't have far to fall into that 7,400. We got a little bit of structure there. To the upside, got a bit of a speed bump at 75, but the bigger level is 76. If you don't read those founders notes that I send out in the mornings, maybe you think they're too complicated or you don't trade options, so you probably won't understand them. Give it a try. They use plain English in there for a lot of it. I mean, don't get me wrong, they throw in some options gook, but there's still just some plain English in there with very clearly written statements like, we think we're going to go higher from here, or we think we're going to go lower from here, right? There's very clear writing. They also offer key dates and specific SPX targets. So if you don't read them, try it out. The PM edition, to be fair, often looks back at what they saw during the day with their own tools. It's the AM edition that kind of goes out on a limb and looks ahead at what is coming at us. So if you're just so busy that you can't read both, think about which one of those is going to help suit your needs better, and then, just pick one. Give yourself a little credit. You'll probably do better with it than you think. And if you need a little help, give it to your friendly AI and ask it questions. Or ask me questions. All right, we got a real low score coming out of the White House today. We're not expecting much on official statements or official events. That doesn't mean he can't just pick up his phone and cause some drama, but there's nothing on the books. That's kind of the best we can run with at the moment. So, speaking of volatility, I will get this put into the Thinkorswim workbook. I need to build it for TradingView, but I do have the code, so all I got to do is just build it and get it done. This is just the VIX here on the right, the big, large chart. Nothing to it. I'm on the daily. These grids here on the left, we got two lines. The VIX, there are various versions of it. There's a 9-day VIX. There's actually a 1-day VIX now. There's a 6-month VIX. And so what I did here is I took the 9 and the 6. And what we're looking for is when they cross each other over, right? The red line is the 9. So when 9 gets above that 6-month, the red line gets up here, it changes color, it gives you this cloud. That's backwardation at its finest. Now there's a lot of VIX tools out there. I mean, there's some fantastic stuff. And none of it costs anything either. And these tools have been around for a long time, and some smart people along the way have built really awesome stuff. This is free too, right? Because I don't sell indicators. But it's not the only thing out there that can help you with the idea of backwardation or spotting when risk is getting settled in across the market. A lot like inflation gets stuck and we just can't get rid of it, right? They're always talking about inflation is sticky, and once you get it, you can't shake it. A lot of times the VIX just pops and drops, volatility rises and falls, and it seems real flash in the pan style, right? It just doesn't stick around. But man, when it does start to stick and really embeds itself, you can't shake it loose. And that's another representation of a volatility that you just can't seem to shake loose. So this top one, that's 9-day and 6 month. Now this one is 6 month and 1 year. So we're looking farther out on the curve. As you can imagine, things way up front, like a 9-day, it's going to be a very responsive, like a very small moving average, a 3 or a 5. It gets whipsawed and manipulated easy. This is much farther out in the curve, 6 month, 1 year, but it's the same logic, same idea. And here I just normalized everything. And whether we are under 0 or not, so I turned it into a ratio. When it comes to these kind of tools, the recommendation is to find a period in time where you know what was going on in the market, something really bad or something really good, and then compare that to whatever tool you happen to be using. So if you think about last year, March, April, we had the tariff terrors and all of that drama. There's the spike through that drama and then out the other side of it, right? Same thing this year. As we got into March, we had a little bit of drama, not as much, but we got up into that 0 line, and we had 6 month over 1 year and 9-day over 6 month. These aren't the kind of tools that you sit staring at all day. You just bring them up, you kind of validate or measure to see what's going on. Then you tuck them away and you're done with them again till the next time you need them. They rolled the call wall up and the put wall down. That creates this sort of jaws looking shape, right? Gives us this sort of scenario there. It's the same sort of shape that you would see in an expanding Bollinger Band, oddly enough. Yes, sir. MU earnings this afternoon. I mean, have you seen the flow in that thing? You could take the flow in like all the other Mag 7 combined, and it still wouldn't be the same as MU's flow. So with the call wall up and the put wall down, the market has given itself some room. It implies that volatility is coming and that there's no directional bias to it. The market makers have pretty much removed any of those bumpers that we were talking about last week and are just getting out of the way. Let price go wherever price wants to go. They also don't need to monetize anytime soon, right? Normally, when price would drop down into a put wall, they would be there to monetize those puts. But with the put wall a lot farther away, it creates a bit of an air pocket of risk. And then, of course, to the upside, there's nothing there, and we can make exaggerated moves in that direction too. Yeah, you remember a few years back when NVIDIA was really important and the whole market went sideways into NVIDIA's earnings. And we had this high correlation coefficient with NVIDIA and basically the NASDAQ, but the whole of the market. If NVIDIA got a cold, the whole market got sick. And then it finally broke. NVIDIA had a bad earnings. It kicked the market in the gut for like 1 day, and then the market just completely disconnected itself. And sure, we've started to tangentially tie it together with NVIDIA again over the years since then, but it's been a much looser connection. Now we're looking at the same scenario with MU. But the market does have this amazing ability to just completely decouple from the situation. So we'll see if they're able to shake it if it is bad. And it's worth asking, what could we get out of it if it is bad? I think we could get that 200 period daily moving average. I do. Maybe it's just wishful thinking, but I wouldn't mind getting that 7100. Not that I want to keep it, right? Just give me a little nibble. Give me a taste. Like chunky peanut butter. I just want just a spoonful. Just give me a little. All right, so our zipper at the moment happens to be the 0 gamma line. As long as we're running around in here, we could just keep crossing back and forth in there. Leaving that zone and then coming back to it may make it act a bit more like a support or resistance level, but as long as we're right there on it, just zipping back and forth, I wouldn't expect any assistance from it. And I would not expect dealer positioning to behave in a positive GEX or a negative GEX scenario. We're just too close to it. We are still underneath the volatility trigger, and that can cause some drama if we did begin to sell off some. And if we make any run to the upside, it's a level we're going to have to deal with. Right around that 10 period daily moving average up here. But we're under the 3-week and the 3-day, and we had a 310 bear surge signal. So we're kind of in a bind. The only good thing, I guess, if we're looking for good things, is that when price crossed under the 3 and the 10, it didn't expand down there deep enough to drag that 3 through the 10 in a deep way. The 3 and the 10, they're still just kind of hanging out together. And both of those are still above the 20 too, even though we're not. Now, I've talked quite a bit about this uh, daily chart and this topping pattern that we're putting in. And these two levels are what really matter right now. Whether or not we're going to set a higher low or a lower low, and whether or not we're going to set a higher high or a lower high. Kind of a big deal. But until we have an answer to that, we're still just in this channel. And your guess is as good as anybody else's guess in a situation like that. We're not leaning against either edge. $83,000 in the overnight. So if you were thinking that they were sitting on their hands because we have this big event coming up with Micron, nope. They are in there getting it done. The average is 50,000 in the overnight. They ran 83 and a half. That's showing an active participation last night. Not that all of that work actually got anything done, because we didn't do anything last night. All right, the ADR. Right now we have an average daily range of 104 points. So from the Globex open last night, we could basically run 52 points up or 52 points down. Did I miss one? My bad. How did I miss one? What did I do? The same one twice? I don't know. I did miss it though. I got you. There you go, kiddo. Hey, morning. Morning, morning. You're welcome. If today turns out to be a hurry up and wait day, we're going to sit inside of these two red lines and really just not do anything else. A lot like we did yesterday. I know that doesn't sound very exciting to set a range like we did yesterday and then just sit inside of it for the rest of the day, but it's what we have at the moment. Now, don't get me wrong, some headline could come in, some sort of macro trigger could spike us and get us moving up or down. No directional bias here in this. But the base case today is that we just hang out, wait on immune. So if we do actually attempt to break out of the RTH of yesterday, that's going to be my focus is a reversal play back inside the box. Now, to the downside, if we break yesterday's low, the 1236 is the ADR half. So that lines up. It's almost spot on. To the upside, 111 is the ADR half ish, close enough. Keep in mind, if we do actually break the RTH high of yesterday, then you want to snap your line to all of yesterday and focus on the real mid. I didn't quite get there, but there we go. Well, we managed to do it. So yesterday, we did not hit our daily pivot. It's kind of nice. It's our first missed daily pivot in a while. Unfortunately, it happened to be a negative one. Today's floor pivot is lower than yesterday's. It's pretty obvious. And that's bearish. Price opened underneath it. That's also bearish. So far today, we haven't hit it. We are now breaking inside that channel, finally. Third time's the charm, or maybe the fourth time is the charm. We got there. Tested and failed, failed, failed. Finally got it. So we're in it. It's very likely now we're going to go ahead and hit it. Now we got to figure out what we're going to do with it once we get there. If we can get above that daily pivot, we've got a greater chance of getting to the top of yesterday. Now that's just the RTH top, but still, it's the one that we really want to focus on. The RTH high of yesterday. It's kind of an important level. 92 cog line. 74 and 92. Now last week we were above the weekly pivot and the distance was great enough that it was causing a little bit of a concern. Now we're underneath the weekly pivot and the distance looks pretty bad, but it's not. That's 2%. I know that feels like a lot, but on the downside, you can get a lot further away from that weekly pivot than you can on the upside. 2% is not bad. The problem is it was 2% away and it was only Monday, right? And into Tuesday. So we haven't gotten very far in those 2 days. 2%. What are we going to do with it from here? if by Thursday we can get another 2%, then we're looking at 4% below the weekly pivot. And that's not enough. That wouldn't cause mean reversion. It wouldn't drive us back to the upside. That wouldn't be overextended, oversold, any other language you want to use. It's not enough. So we are underneath the weekly. That puts us in a bearish bias, have a bearish tone. It does imply the broader market's weakness and that we have work to do if we want to get back into a more healthy, normalized scenario. But we're not oversold, we're not overextended, and it doesn't owe us a move back up simply because of how far we fell so far this week. There's no perfect answer on how far away from that weekly pivot we can get. The weekly pivot is different than the weekly 10 period moving average, which is why I look at both. But 2% isn't enough. Now these S&R lines that we're about to look at, they get stretched considerably based on the previous day's trading. So if you look at Monday, it was kind of narrow, not a lot of distance. And that was really based on that sort of broken holiday price. But look at Friday, it was a pretty good size, or Thursday, it was a pretty good size stretch because of how wide price moved on Wednesday, right? That price is what gave us our lines for Thursday. So Monday was muted. Tuesday, since we didn't do much on Monday, those lines were kind of muted as well. But Tuesday, we moved, right? We had some decent movement yesterday. And now our lines are much wider. So the bigger the move yesterday, the wider the lines today. And we've got some pretty wide lines today. We want to focus on how far away R1 is and how far away S1 is from this floor pivot. It's called the path of least resistance. So if visually speaking, if they're so close together that you can't see it, then it really doesn't matter. But if you come in and you turn on the lines and you can see that, for an example, the green line is a lot farther away than the red line, then it's obvious and it stands out, and that's your path of least resistance. This green line is farther away from the floor pivot than that red line is. Path of least resistance is to the downside. That does not mean we have to go down. Doesn't mean we got to go up. It's just giving us some insight on if we were to attempt to go down or up, what's more likely? Well, the path of least resistance is down. It's more likely we go down than up. Much like the ADR that we were looking at, it's conceivable that we just hang out today in between R1 and S1 without actually hitting either one of them, waiting on MU, and that we just hang out here and chill today. Dispersion is alive and well. This indicator is the cumulative volume index. It's basically net buying versus net selling. So when it's rising, we're net buying, and when it's falling, net selling. And to be fair, it's looking at the NASDAQ, but the NASDAQ, the S&P, the indices collectively, things are still fine. this thing just barely came back in the Bollinger Bands, which are expanding, by the way. It's above all its major moving averages. It's elevated at the highs. So even though the indices have rolled over and we're not getting it done, the broader market is fine. We're not looking at big risk here at this point. Major sell-offs and, shorting the Mag 7 and all that. I would not get heavily bared up in your long-term portfolio because we don't have those kind of signals. I even think the rate hike is a bluff. I think it's lies. We'll see. It's all a part of the game they're playing. So what we have this week, this double distribution. The upside distribution really is a continuation of last week's point of control, just a little lower down. 42 is a old school cog line. We don't really use it anymore, but can't forget it. So this is a channel or a zone, and it's going to be a very difficult level to get through. It's about 20 points wide, 75.40 to 75.60. But we're building a new level down here, 74.50 area. It's where the point of control is now. And unless we run back up and challenge Monday's levels, then it's likely this is going to be where we hang out or we expand lower from here. To the downside, we don't really have a lot of help till we get to the channel around 73. It's these 2 points of control. We had 2 weeks that were like back-to-back points of control areas. It's right underneath 7,300. At this point, it's about 150 points away, 160-ish. What's a few points among friends? And if we lose that, well, we really don't have a lot down there. There's an untouched point of control, 71, 75. I don't like it, but, nobody asked me. How many weeks we got here? Not quite 2 months. But this is the playground that we're in, right? That 400-point zone range. And sadly enough, we could sit in this 400-point range for the summer. I know that wouldn't be what a lot of people want to hear, but I mean, it doesn't owe us anything. We got to get through MU today. And I know a lot of people think that we're going to get answers today with MU, but there's 3 outcomes, right? Not 2. It's not this binary event where we're going to go up or we're going to go down. There is the third one where we don't get good answers and we continue this sideways, sloppy, choppy mess while we look ahead to some other event, because there's always another event. So if you're shopping around for some lottery tickets or you want to play some YOLOs, just keep in mind that that third choice could break whatever trade you're trying to run. Beyond that, it wouldn't hurt to shop around for some YOLOs or a lottery ticket. Just remember, it's a lottery ticket. It's supposed to be cheap. So don't risk, a couple of grand on a maybe because you're just guessing. 10-day, 30-minute volume profile in TPO. We are building out this new level down here thanks to that sideways trash from yesterday. 74.42 old school cog line. We don't use it anymore, which is 100 points lower from our current point of control, also on the 42. So 75.42. If we sit here all day today, maybe into earnings tonight, then we could see that point of control come down. I don't think we got enough juice today to get it done. I think we would need more than one day to do that. But throughout the day today, we're likely going to start to get into these candles. I know that that's just the tip of the iceberg. And we would need another week to get into these candles, and then still another week to get into these candles, and all of this. So we're not going to move that point of control by eliminating the candles that created it. We're going to have to move it by a combination of eliminating some candles while also building out a whole new level. We're in the process of doing that, but if we leave this zone that we've been talking about all morning, then we're leaving our opportunity to continue to build that out, and we're going to have to hunt around for a new home. The number one thing to focus on is that the current point of control isn't looking to move anytime soon. It should still be there for at least the week. Monday we come in, we'll deal with what we get at that point. Still have that key level from yesterday. It's not a VPOC, but I'm keeping it. It's a key level. Still need to see what we're going to get if we make a run at it, and sooner or later we will make a run at it. We have that June 11 VPOC underneath it. Yesterday's point of control is not a VPOC. There's no reason to mark it. I have no interest in it. Today's price has just been continuing yesterday's trading activity. We did get that high zone around the value area high. So if you wanted to do like the textbooks say and drag that line across, at least today it would make sense to do it because you had a high volume node there. The other one where the point of control happens to be, it's basically our own value area low at the moment. And our point of control is not very far away from it either. We've got a classic distribution this morning, although it might not feel like it just because it's so constricted and narrow. It's a lot of work in a very tight space, and for all their effort, they're not getting anything out of it at this point. With this light drive to the upside, we are attempting to get back inside the box. We're not there yet. We have a 70% chance of closing within this range by the end of the week. So Friday's close. But Friday's a long ways away from where we're at right now. We're still above the 10-week. We're not overbought. We're not overextended. We certainly are not oversold or overextended. That fall may have felt like a lot, but looking at the weekly, we're not even back to the weekly yet. We could fall another 1% and just be at the line. We could fall 3% and we still wouldn't be oversold. At least on the weekly. Now looking at the daily, I've got this sort of an imaginary box, 1% below and 1% above. It's the same thing as the 0.5% above and below, just a little bit bigger. And as long as we're inside of that, there's no entertaining the idea that we've traveled too far, too fast. There's no mean reversion, dot plot statistics, least squared methods. nothing to imply, suggest, or recommend mean reversion. Rate of change can really freak people out, right? How fast we fall, not necessarily how far we fall. But you can't get the two mixed up, right? So looking at this, we're down, we're underneath the 10-day. Yeah, but we're not even 1% below the 10-day. And that means we could easily fall another 2% and we still wouldn't be at extremes. We'd be getting close to those extremes, but we wouldn't quite be there. So yeah, it's a little negative, but it's not extreme. And if you look at where we're at right now, we'll just put my mouse there. And you look back over the last 2 years, 3 years, we've been much lower than this and have stayed lower than this for long periods of time. 0.8 is nothing. All right, looking at what's down this morning, the VIX is down 3%. It was up 18% in 5 days. So coming down just a little bit after that doesn't really feel all that negative. Junior miners and miners are down. The Mag 7 down volume is down, and yes, that is a double negative, so it's actually a good thing. But it was up around 10.5% in a 5-day period. So the fact that it's down a little bit now, kind of needed it. China is also down. Really, that's about it. China, gold, energy, and the VIX. Now, there's a whole lot of stuff that isn't even really moving around this morning, and quite a bit that is not up enough to meet our qualifications. I'm using 0.5% as my benchmark. So all of this stuff that isn't up a half, we don't want to count it yet. The Mag 7, airlines, robots, quantum computing, and those matter, right? Those sort of risky markets, if they're not willing to trade those riskier things, then they're more selective about money flow, and it just puts us in a less risk on environment. But they are up this morning. They're just not there. So keep your eye on them. See if we lose them through the morning. We're also in a really divergent marketplace. We're getting conflicting signals in the tools that we use. Saw it yesterday, really saw it Monday. So when the tools aren't giving you good answers, the solution is not to try to read the tea leaves or, squint at it and imagine an answer. The solution is to just throw up your hands and say, this tool right now isn't working and I can't use it. I know it sucks, but you just got to own it and say, I can't use it. And then you move on. Find some other way to get the answer. So, what we do have this morning: solar, chips, nat gas, and Bitcoin, bonds, and that's about it. You don't want a rally day on this, right? Don't get me wrong, chips is fine, but it's not enough, especially if that's not leading. Now, during the Middle East situation, when we had crude up and the VIX up, those were really much more influential to the S&P and the Nasdaq, and the broader market just had to take a back seat. But now we don't have crude up and we don't have the VIX up in that dichotomy. Still getting some elevated VIX, but for new reasons. So dealer positioning and growth versus value is kind of back on the table. So we want to watch the names that are up or the names that are down and see if they change along the way. This is chips versus software, SMH versus IGV. Now, if I zoom out, you'll just see that we've been climbing and climbing and climbing and climbing forever. Well, damn, yeah, that's not very helpful. Thanks, right? So you got to do something with it to get some value out of it. So I threw a stochastics down here, put a Bollinger Band on it, which has a built-in moving average. Now we get a little bit of context around it. When software becomes dominant over chips, we tend to get S&P weakness. Now my mouse is synchronized to this chart on the right, which happens to just be the SPX. So that when we zoom out and we look at this sell-off here down into the April lows, you can see where it started. Watch this side where my mouse syncs with this side. There's the peak of the ratio. The ratio starts to sell off. We get below the 20. We get to the lower edge of the Bollinger, and we're hanging out along these lows. Sure, it started to rise again, but we weren't pressing, and we had a constricted Bollinger, and we had weakness in the broader markets. Now, this isn't a one-for-one thing where, it goes up, the market goes up, and it goes down, the market goes down. It's not textbook perfect. It's just a broader outlook. If you've got continued weakness in chips and software is dominant, you're going to have problems in the broader market. That's what we're seeing, right? It's that weakness. And it's not done yet. It's still pointed down. Now, in the pre-market today, it's up. Then there's no blue line going up because it's still pre-market. But that jagged little move up is just one day. It's just noise. We need to see where it's headed in the overall big picture. And in the big picture, when I zoom out, it's very clear we're still chips over software. And if you look at the S&P, still very clear we're hanging out up here, not down here in the middle. So don't get all bared up in your portfolios yet. Today should be a relatively simple day. If you didn't like yesterday afternoon in this choppy, violent, sideways mess, you're probably not going to like today either. The base case today is that we're going to sit sideways and wait on Micron MU earnings. That's the base case. And it doesn't have to be, right? We can get some headlines that break us out of this and the market just says, screw it. But I won't believe it until I see it. So if you don't like trading in this choppy, violent, really compressed range, then wait until we get out of the box. If we get above 75.01, which is the ADR half, we can make a run to the full ADR. Same thing down below. If we get below 73.98, then we can make a run to the full ADR. To get to either one of those red lines, we've got to break out of the box. That's yesterday's high, yesterday's low on the RTH. To even get out of that, we've got to get out of our own Globex box. It's our Globex high and our Globex low. If we're still within this range at 930, then that is the very first thing you need to get out of before you get anything else done. You got to get out of this box. Otherwise, this sort of price action is what you're going to be dealing with. And I don't know about you, but I don't like to trade this. I don't even bother trading that. That's what I got for you guys. Be careful, be safe, watch the clock. I'll see y'all.